Moving on then with books of prime entry, we're now going to have a look at returns day books, so for sales and purchase returns. So we are going to need the ledger accounts that we used for the second and third recording previous to this in terms of the receivables and payables control account illustrative example, where we popped in some numbers from the day books that we looked at in the previous two recordings. So we're really going to continue that theme of day books and then show how it's posted to the control accounts and the subsidiary ledger as well. So let's first have a look then at the sales returns day book. And if you remember from our first video of this chapter, we said that that lists credit notes, sent to customers. Okay, so lists credit notes that we sent to customers. So if a customer returns goods to us, well then they're not going to owe as much money as what we initially thought on the invoice. We'll give them a credit note to show that they don't have to pay us as much. Now this is the first time that we've seen returns, and really they're the opposite of sales. Okay, so let's go straight into this then. Notice again is pretty similar to what we've seen previously, but rather than invoice number we now have the credit note number that we issue to the customer. So notice then we've got customer Chris, and we're sending a credit note with a net amount of 50. Remember, the net amount is always after trade discount has been charged, and that's the same for credit notes as well. So if you remember on our chapter on sales tax, we said that the net amount was the list price less trade discount, and that the same would apply here. The net amount is the list price less trade discount on the credit note. We've then got sales tax and then the gross amount. And notice there's only one credit note that's been issued in the week of December, so we don't need to pull off a total because there's only one figure in there. If there was more than one customer we're doing credit notes to, of course we're going to post to the main ledger from the totals. So, posting to main ledger from the totals. Now a return is the exact opposite of a sale. So think about your double entry for a credit sale, and now reverse the debits and credits, and that would be a return. So the net amount then, and in this case the total net amount of the return is 50. When you recognise sales income, you're going to credit and increase income of sales. Well, now we've got returns. We have a debit because it's going to reduce our income in our statement of comprehensive income. But rather than debiting sales, we're actually going to debit an account called sales returns. And as you may have guessed, this is an expense account. We do have to show credit notes or returns separately away from sales. So if you imagine the statement of comprehensive income, you have sales at the top. Immediately you will then deduct sales returns, and then that's going to give you your net sales, which you will offset against cost of sales to get gross profit. So essentially it's just reducing your income in the year, and that's what returns do. Now, when we make a credit sale, we recognise a liability payable to Her Majesty's Revenue and Customs for the sales tax that we've charged. Now, as soon as we've invoiced the customer, we'll recognise that payable now. But if we're sending a credit note to the customer, we're no longer going to receive the cash from the customer to then pay the sales tax to Her Majesty's Revenue and Customs or the local tax authority. So as a result then, we can reduce our liability and debit to reduce sales tax control account. Okay. If you remember, when we make a credit sale, we increase the liability. Well, a return, as I mentioned, was the opposite, so that's going to decrease it down. You don't have to pay as much to the tax authority now for the sales tax. Now, the total of the gross amount, well, if your customer is making a return to you, they don't owe you that money anymore because they've returned the goods back to you. They were faulty or some other reason. So as a result, then, we're going to credit and reduce down our asset of receivables control account. And if you remember, the receivables control account is the asset that we're going to show in the statement of financial position, the main ledger. And notice that our 2 debits there will equal the credit to receivables control. Now remember the rule. Anything that gets posted to receivables control must also go to the subsidiary receivables ledger. And as such, we're going to credit customer Chris's account in the subsidiary sales or receivables ledger. So we're going to need to pull up that illustrative example that we did in the second video of this chapter where we looked at the sales day book. And if you remember, we had a receivables control account and we're starting with the debit that we already posted from the sales day book. So in the control account, we're going to reduce down the asset from the sales returns day book with the total amount of the return, which was $57.50. And that's going to reduce the amount overall our customers owe to us. I'm not going to worry about the debit entries. Like I say, the focus of this is really the effect on receivables and payables. Now, we've put the credit in the control account. We must also put the credit into customer Chris's account. There we have it. SRDB stands for Sales Returns Day Book. And the gross amount of the credit note, $57.50, is going to reduce the amount that Chris owes to us. Okay. So a couple of things to note there. Remember, the net amount of the return is always after trade discount, and the net amount will get posted as an expense to sales returns in the statement of comprehensive income, which will reduce the sales figure at the top of the statement of comprehensive income. And just to remember, a return reduces the receivable in the control account and also in the subsidiary ledger as well. So, sales returns day book, we've now done that. But in order to finish this video, we're going to have a look at purchase returns. So, if we could go back to your notes, please. Let's now have a look at the purchase returns day book. Now, the purchase returns day book lists all credit notes received from suppliers. Now, much in the same way as what we did with the sales returns day book, purchase returns is where we are returning goods to the supplier and it's going to reduce the amount that we owe to our supplier. We like purchase returns, they're a good thing in terms of the fact that they reduce our expense of purchases. So if we have a look then, again, we can see then that we've got the date, the credit note number, the name of the supplier who is giving us the credit note to reduce the value of the invoices that we need to pay, net sales tax and gross. So we can see then that we've received a credit note of $115 gross from supplier Anne, and we're going to account for the double entry from the totals. So postings to main ledger from the totals. And because we've only received one credit note, the total is essentially the same as the credit note value. So thinking about the net amount then, purchase returns are the opposite of purchases. Now, the net amount of purchases would go to the debit side of the purchases expense account. So this is going to reduce our expense of purchases, so it will be a credit. Well, we don't credit purchases. We need to show the credit note separately. So we're going to credit purchase returns account, and that's a form of income. Now, this would get shown in cost of sales. Opening inventory plus purchases minus purchase returns and then minus closing inventory to give total cost of sales, which will come off your sales less sales returns. Okay? So it's an income account, and it will be shown as a deduction from cost of sales. Now, when we purchase goods, we are entitled to a refund of the money that we pay to the supplier in terms of the sales tax, and we get that refund from the tax authority. And what we do is, when we purchase the goods, is reduce our sales tax liability. Well, in this case, because we've got a return, we've overclaimed the amount of refund we can get, and therefore we need to increase the liability back up for sales tax. And that would be a credit entry. Increase the liability of sales tax control. Opposite to what we did when we looked at a purchase invoice. Now, the gross amount then, we don't have to pay that money to the supplier anymore. That's what a credit note is for. That's going to reduce our liability of payables. So we're going to debit and reduce payables. But remember now, in the main ledger, we call trade payables, payables control account. And we're reducing our liability. Now, what we must also do is anything that goes into the control account must also go to the subsidiary payables ledger. So we're going to have to debit supplier Anne's account to reduce the amount that we owe to supplier Anne. So again, it keeps control over who we owe money to. Now, in the previous recording, we set up a payables control account and 4 individual supplier accounts as an illustrative example. May I ask that you pull that off again, please? And if you remember, our illustration started with the payables control account, and from the last video we popped in a credit from the purchase day book. Well, now in the control account, we're going to pop in a debit from the purchase returns day book, and that would be with $115 that we got a credit note from supplier Anne from. Okay, and that's going to reduce our liability of payables. If we do it in the control account, we must also do it into the individual supplier's account in the subsidiary payables ledger. And we're going to go to supplier Anne, and from the PRDB, the purchase returns day book, we're going to post 115 debit to reduce down how much we owe to supplier Anne. And again, if you added up the balances carried forward on each individual supplier account and matched that to the payables control account balance carried forward, they would still be the same. And that's what we're going to do towards the end of these recordings. Remember the rule. Anything that goes to the control account must also be posted to the individual subsidiary ledgers as well. So we're done with returns day books. You could be asked to calculate values for inclusion in the day books in the exam, or you may be required to post entries from the day books to the accounts. Thank you.